Good morning, everyone, and thank you for joining us for our webinar on business valuation concepts presented by Rehmann. We have Greg Light with us. He has been with Rehmann for over 11 years, and this is his area of expertise. So he will be going through a presentation. Please feel free to utilize the chat to ask questions, to comment. We will be doing Q&A throughout the presentation, so let us know if you have anything that you would like more information on. We ask that you please mute your devices and turn off video to help optimize the streaming quality. And as always, we would like to thank our sponsors for making these mini forums possible. We have Fifth Third Bank, Huntington Bank, William Vaughn Company, Skylight Financial, Shoemaker Loop and Kendrick, Eastman and Smith, Highland, and Raymond. So with that, I am going to give it over to Greg, and please, again, utilize the chat if you have any questions. Thank you.
Good morning. Thank you. Happy to be here with you all this morning. It's kind of sad. I look out my window here and see all the snow, whereas this time last week I was sitting on a fishing charter boat in Florida. So can't say this is the first place I want to be, but it's the second place I want to be. So we'll get started here. A little bit about myself. There's my bio. I've been with Rehmann for a little over 11 years and about 16 years in the industry in general. Before Rehmann, I was with a firm called Duff and Phelps, very, very, very large valuation firm. You can see the number in there, valuations of over $150 billion in revenue. We did a lot of work for Berkshire Hathaway, the big three auto manufacturers, some really interesting work, but got tired of working 400 hours a month and never seeing my children awake. So made the switch to Rehmann for better quality of life. And 11 years later, I've never been happier and never looked back. So that's just a little bit about my background. Topics of discussion for today, and I know it was mentioned in the intro, but please ask questions. This Zoom format, it's even easier. You don't have to stand up and have me walk a microphone over to you to ask the question. Just type it in the chat box and Emily will let me know when there's questions and I can do my best to answer them. Chances are if you have a question, multiple people in the audience have the same question as well. So making the process interactive is helpful for everyone for sure. So we are going to talk about the key value drivers of a business, uncovering the skeletons in the closet, the due diligence process, marketing a business for sale, common pitfalls for business owners, cash at closing versus seller notes, pre versus post-tax proceeds, and then some current valuation trends. So I used to explain valuation in a way that would make people's eyes kind of glass over, and you could see people when I would present in person starting to nod off a little bit, and it was really boring and analytical and technical. And then I was talking to somebody and they said, what really drives the value of a business? And I started going into my spiel and I was like, you know what, wait, let's boil this down. Let's simplify this. It's cash flow and it's risk. It's those two things in some way, shape, or form. Every valuation method that we use, whether it's an income-based approach, a market-based approach, an asset-based approach, takes into these two things, and it takes these things into account in some fashion. When we look at cash flow, we're looking at, is this sustainable? What has been done historically? How does that translate to what's expected going forward? How much is a potential buyer going to believe in the cash flow that we're showing as sustainable? Another big distinction is earnings versus cash flow. We don't necessarily just look at the net income of a business or whatever the accounting measure of earnings is on the books. We want to know what cash flow is, which is basically an after-tax income type number that you might see on an accounting statement, but then there's some adjustments. We add back depreciation, since that's not a cash expense. We subtract off capital expenditures, since that is a very real cash flow. You have to spend your hard-earned money to make to acquire a piece of equipment, but it doesn't show up on your income statement. Then we also make adjustments for changes in working capital that occur as you grow. So if you have receivables that extend out for 6 months, how does that impact things? How much more cash do you have to retain within the business to support that future growth? Non-cash items, that's what I just talked about. There can be other ones as well. Tax to book adjustments, things like that. Non-recurring items, we see that a lot of the time with moving expense or developing a website, things like that. And then in small business valuation, personal expenses are probably the biggest thing that we see. I had a client come in and they handed me a tax return, and we started talking about things. This was back in the pre-COVID days when we could actually meet face to face. I'm in Michigan, so we're still fairly shut down unless we're essential. But this person hands me a tax return, and one of the first things I always ask when being engaged is, well, give me an idea. What do you think it's worth? I want to manage expectations right from the get-go. And I'm looking at this tax return that shows literally $10,000 worth of income. And the person tells me they own 10% of the business. They think it's worth $6 or $7 million. So as a valuation person, it's like, oh no, here we go again. Managing expectations that are so far removed from reality that it's going to be, I'm the bad guy once again. So I start saying, okay, help me understand this. Why do you think it's worth so much? Oh, well, every month I get a salary of $20,000 and I take my credit card bill in, and the company, the company just pays my credit card bill. Total about $500,000 a year. And I don't do anything at the company. I don't work there. So now all of a sudden we go from $10,000 a year in cash flow to $500,000 a year in cash flow for the company. So I say, okay, maybe I can see how you're getting up to this $6 or $7 million value. It still sounds high, but I see how maybe you're getting there. And this person says to me, no, I think my 10% is worth $6 or $7 million. So meaning the whole company is worth 60 or 70 million. Basically an implied multiple of 120 times cash flow, which is absurd. Even if you were a startup software company that's publicly traded, you're not trading for 120 times most likely. So again, now managing expectations once again, and I say, okay, help me. What else is there? What leads you to believe it's worth that much? And she tells me, well, I am one of 24 family members that have the same situation. So now all of a sudden, this company that looked like it was making $10,000 a year, in reality was making like $12 million a year. Big, quite the difference from what's shown on a tax return to what the true earning potential is for the business. That's about as egregious of a level of personal expenses I've ever seen run through a business, but it does exist out there sometimes. And those are the things that need to be adjusted back into coming up with cash flow for valuation of a business. So that's that side of it. Now, the risk side of the equation, equally as important. Just because I'm talking about it second doesn't mean it's less important than cash flow. A lot of different things lead to risk for a business. Believe it or not, size is the biggest one. The first time I heard that and saw the correlation between risk and size, it kind of said, what do you mean? And then somebody started telling me, qualitatively, if you think about it, the bigger the company, the more customer diversity they have, the more geographic diversity they have, the more likely they are to have a formal board of directors that has experience in the industry. They're able to weather an economic storm better. They have, banking relationships, all those things. So the small size of a company leads to more risk in general, and therefore lower multiples. That's one of the things that when we talk about risk, valuations, like every technical industry, there's like 12 different words that mean the same thing a lot of the time. Risk, rate of return, cost of capital, present value factor. There's some nuances between them, but in effect, they all mean the same thing. And that is, if I'm taking on this level of risk, what rate of return should I expect to receive? And that rate of return translates to that multiple of cash flow. Excuse me. So there's, you can see some of these other factors, a lot of which are included within size. And then the biggest one that we see in smaller business valuation is the key person risk. How risky is this business in terms of what happens if the business owner gets hit by the proverbial bus? Can the business sustain itself? How long can it sustain itself for? What would have to be done to keep the business going absent that key person? So, uncovering some skeletons in the closet. When a business is being put up for sale, or in advance of a business being put up for sale, we always recommend looking at, okay, what are the bad things that have happened in the past that could have an impact on cash flow or risk? Most of this stuff relates to risk. Some of it does relate to cash flow, though. So it really comes down to which of these items matter. And if you look at it from a buyer's perspective, the things that are not going to matter to them are the things that make sense from an operational perspective or from a family planning perspective. You have a child on the payroll, or you ran personal expenses through the company to save taxes. That kind of stuff, a buyer's going to be like, yeah, I get it. Everybody does that kind of stuff. Maybe they shouldn't, from a, tax perspective, is it legal to run those personal expenses through? No, but a lot of people do it and don't get caught. So, okay, fine. Yeah, we'll make that adjustment when we look at cash flow and the risk of the business. Other stuff, history of lawsuits, bad debt, for example, those sorts of things, that can indicate structural issues within the business that are the things that are going to be scary for a buyer. The problem is, what can you really do about it? All you can really do is clean it up, identify it, be forthright with it or forthcoming with it, and then your only friend on this is fixing the problem and then the passage of time. How far in the rearview mirror can I, can these things be? Because, say you had lawsuits 3 years in a row. That looks pretty bad if it's 2018, 19, and 20. But if, you can say there was a bad actor that was in the business and, you got rid of them and those lawsuits were in 14, 15, 16, and the last 4 years have been clean, that looks pretty good from a buyer's perspective. That was something that, and management was strong. They identified an issue, they cleaned up that issue, and it's not going to happen again. So these are the things that when we do a business valuation, we try to look through and help business owners identify these things, what the impact on valuation is from a risk perspective, things like that, and help them know what those items would be if they were to try to sell their business, for example. We find this stuff through valuation, fairly informal. But what happens when you actually are selling your business, it becomes a bit more formal. The buyer typically will engage you in some sort of due diligence. So what to expect during that? There should always be some sort of a non-disclosure agreement up front. And then you have to decide what data are you willing to share? When are you going to share certain parts of it? Are there certain steps that are met or, steps that are taken that make it so once we get to this point, there's going to be a non-refundable deposit on this transaction. If they back out after a certain point. And only once that happens will you share your customer list or what some of your patented technology might be. Due diligence is oftentimes an uncomfortable process. The reason I see it being uncomfortable is typically business owners get very defensive when people ask questions about why they did things or what the what certain anomalies were in the past. It doesn't have to be that way. It's just business. To think about it as I'm not being attacked. This is just someone who's doing their job and trying to get to the bottom of things so they can recommend to their client, the buyer, that it's okay to make the acquisition. And everything comes out in the end being as forthcoming as possible is, I think, certainly the way to go. It really depends on who the buyer is and how big of a deal the potential transaction is that influences how in depth the due diligence process is. I worked with a client who was buying a $500,000 business, and they most certainly were not going to spend $20,000 on a formal due diligence process with another firm to do the work. So we did a little bit of diet due diligence, for lack of a better word, to help them based on some stuff we'd seen from the valuation perspective. And then them and their attorney requested some certain documents just to, make sure corporate filings were up to date, no outstanding lawsuits, no liens on assets, things like that. That worked out for them. It was $5,000 and gave them some peace of mind, but they didn't do more digging than they needed to. A lot of due diligence is industry specific. I work with a lot of companies that do equipment rental, and when they're making an acquisition, they're going in and looking at the equipment, the condition and the age and the model of the equipment that they're buying. That could be thousands of pieces of equipment that are out at customer sites. Typically, that's not the level of due diligence that's going on in an acquisition of a machine shop or something like that, because all the equipment's in one place and somebody can go in and look at it right there. Or a software company, there's nothing to even look at from a equipment perspective because it's all just computers.
We're just getting antibiotics and she's gonna have her hemorrhage moved. Got her done.
Good.
If they didn't, I was calling a different doctor.
I think we've got some people not on mute. If you can mute your lines, that'd be helpful. Thank you. So customer perspective, that's what scares a lot of people the most. Is, am I really going to give a potential acquirer a list of all my customers and the work I'm doing with them? And a lot of my clients will say to me, there's no way I'm doing that. I don't care if we're, the day before closing, I'm not giving them a list of my customers. And a lot of the time I say, is it really going to be a surprise who your customers are? Go back to that equipment rental, example I was talking about. I've heard that before. I'm not going to say who my customers are. It's like, you rent construction equipment. It's no surprise who your customers are. If you're one of the major players in town, they can go look at any heavy equipment construction type of company. And chances are, if it's not your acquirer's customer, it's your customer. You giving them a list of them is not doing that much damage, because they already know who all these customers are. They have marketing people. They have, salespeople that are already, they know who these people are, and they can go out and try to find them themselves. Last one, working capital. This is more so for documenting something in the purchase agreement to say at closing, we're going to deliver X amount of working capital. You see this either being very simple or all the way to very complicated, where people are auditing what your collectible amount of receivables are every month going back for 36 months and what, how much inventory should have been written off. In general, it's looking at a 12-month average of historical working capital and using that to tie to for a target amount at closing, unless there's some seasonality involved with it. But yeah, part of the process that can get not sticky, but very time consuming. So when you do actually market a business for sale, what do you do? How do you do it? Are you going to have professional assistance with it? Some people will undertake a full process, which is where you have a investment banker or business broker that will create what's called a CIM, confidential information memorandum, that will be a 40, 50-page glossy brochure of your business, either company XYZ, with specific details held back so nobody knows exactly who it is. Or if it's not a big deal for people to know your business is for sale, it'll have your company name in it. And they go out and, market that to 200 firms that they think might be interested, whether it be industry participants, private equity firms, people like that, and then start narrowing the funnel down and down and down until they get to hopefully 4, 5, 6, 7, 8 offers that can be evaluated to see which one's going to, accomplish your goals for price and getting a deal done and ability to get a deal done, things like that. The next step might be just having somebody like that assist you with negotiations, where they might be, on an hourly type basis. A lot less expensive, a lot less service being provided. But if you already know who a potential buyer might be, or somebody's approached you, that can be a cheaper, more streamlined way to go about it. And then the last one is just what I would call oversight. We've been brought in to do this a few times in conjunction with like a trusted transactional type attorney, where we're doing everything we can to make sure a business owner's rights and everything that should be fair for them is being protected. Really just an hourly type of process, depending on how much help they need. Good to have somebody by your side throughout the process, though, in some fashion, in some, in one of these levels. The fees associated with the sale, and this is more so based on the full process that I mentioned above. Some will be a success-based fee. Could be, if I had to give a very broad range, I would say 6 to 10% of the sales price. The larger deals, you might start getting, lower on that spectrum, below 6%. Once you start getting up to the, the 8, 9 figure type of transaction price. Some people will, if they have doubts as to the seriousness of a buyer actually selling, of a seller actually selling, they might require some sort of an upfront fee for putting together all that documentation so that they make sure that they're getting something if the seller backs out at the last minute. And then most of the time we see some sort of a combination of the two. So some sort of hourly type of fee for putting together all the marketing documents and brochures. And then, that's just kind of to cover costs for the transaction intermediary. And then there's some sort of a success-based fee if they do end up selling it. Timeline, I generally think of this as like a 3 to 6 month process. If you're truly rip-roaring ready to go. I'd much prefer you come to me when you're thinking about selling your business in 2 years than in 3 months, because then we can actually start doing some stuff with, additional value consulting, cleaning up some and identifying some of those skeletons in the closet, things like that, to make it hopefully a much more saleable business. Time is your number one asset when it comes to transitioning out of your business. Qualifying buyers. This is something that transaction intermediaries are really good at, is making sure that people that want to make an offer for your business are actually financially able to, as opposed to people coming in and just kind of kicking the tires. So that's a very important step in the process. You don't want to go through due diligence and things like that and have offers from people that do not have the financial wherewithal to actually complete the deal. Any questions out there? While I take a sip of water here, it's a lot of info. I know somebody's got some question. All right, moving on. Common pitfalls for business owners. I know I've touched on some of these already, but I'll just go through them again. Not truly assessing the risks in their business. This is the number one thing I see with small business owners. Somebody comes in and during due diligence says, oh, I see there's this receivable for $60,000 from Jim so-and-so. Why has that been sitting out there for 6 months? I'm not paying you for that. I'm not, taking that receivable on and giving you full compensation for it. And the business owner says, oh, no, I've known Jim for 30 years. He's been doing a lot of work with me. He just had his daughter's wedding. He told me he's going to get me that, and as soon as this big sale comes in from XYZ client, 100%. And if you're the buyer, you're sitting there like, yeah, okay, I don't know Jim from anybody. I'm not taking over that receivable. You as the seller, you can keep that receivable, and I'm just not paying you for it. And if you're so confident on it, fine, you're going to collect it. These are the things that we see all the time. Like I mentioned earlier, getting hit by the proverbial bus. A lot of business owners have a sense of immortality, that nothing bad's ever going to happen to them because nothing bad's ever happened to them yet. So they don't even think about how the business would run without them. Or they think to themselves, oh yeah, I got a great team. They can handle things fine. Maybe they could, but it would be very hard for them to do that because they've never been the ones that had to make some of the executive decisions on their own. And there can be confidence that they would make the right decision, but it's hard to make that decision if you've never been asked to make it before. So that's where some of the transitioning of responsibilities comes in to make a business more saleable. A lot of this gets to this second point, a business versus a job. One of my mentors, when I first got into this business, said that to something along those lines to one of our clients. He said, Bob, for lack of a better name, Bob, I really like what you're doing here. You're making a lot of money, but you have a job. It's a really good paying job, but you don't have a business. You're 84 years old. You do all this consulting. You have, one administrative assistant. You can't sell this business. You have a job. And when you retire or pass away, it's worth zero. And I said, that's a good way to look at it. You can make more money sometimes on a job, but it's not a saleable business. Kind of related to that same thing is business owners frequently put a lot of value on legacy. And that's great. Having that name above the door that's been there for 50 years, 75 years, there is absolutely value to that. But keep in mind that sometimes that is value only to you. And again, that's fine. That's great in a lot of cases, but knowing that you might not be able to sell to maximize the proceeds from the sale of the business if there is that value that you're placing on legacy. Because like the next bullet point, selling to a competitor, sometimes it doesn't make sense for them to keep that name on the door. They might be the one that make the most sense because there's synergies there's customer overlap. So they're willing to give you more than anybody else would, but they're going to change the name. That's where it comes down to, okay, what is most important for me? Do I want to sell this to somebody who's going to keep things exactly the same that they are, and I can still drive by every day on my way to get my coffee in the morning and still see that, that name sitting there that I helped to build? If so, then it might not be a way to maximize the sales price of the business, which is fine. It's just a decision that has to be made. Not wanting to sell to a competitor because of ego or, fighting them in the trenches for the last 30 years. Same thing. I get it. It just really depends on what makes the most sense, and how much you need to get out of the sale of a business. And if that's the one that's offering the most, do you swallow your pride, or do you stick to your beliefs and not be willing to sell to somebody like that because you have hated them for 30 years? You fought them tooth and nail, and there's no way they're going to be the one to take over your business. Qualifying buyers, we talked about that a little bit. This is kind of the flip side of it, in that people will often get an eye-popping offer from somebody where they just throw it out there. And, oh yeah, I'm gonna $30 million. I'm selling my business. Yeah, these guys offered me $30 million. Let's go. Let's talk. Let's go through due diligence. Blah blah blah. And in reality, that company was just kicking tires. They made an offer to get you to open the books to them, and it's not anything that ever could actually come to fruition. But the number sounded so good that it was enough to get the door open to continue the talks. I think of these next two as being very closely related, taking offense to questions and being defensive. Sorry, lots of conference calls and talking already this morning, so losing my voice a little bit here. Not being able to see the forest through the trees and know that these questions are merely meant to help someone understand the inner workings of the business and fairly evaluate it and go through the due diligence process. It's easy to get defensive, but that transparency and that openness and that honestness, it really helps to make buyers comfortable that they're getting a fair shake when they ask a question about a potentially difficult topic or a difficult time in the company's history. Also, a lot of business owners only hear the good news. Hard to separate sometimes when, there's a mixed bag of info that comes in from due diligence or from a business valuation. It's easy to only hear the things that somebody like myself says that you're doing well, and wanting to ignore the difficult things, because those difficult things are the hard work that would be required going forward to try to raise the value of the business. Oftentimes we'll give a what I would call like an as is current value of the business and how it should be if all of these changes and suggestions are taken into account. It's very easy to look at the current situation and then look at what the value could be and not be willing to take all the steps required to make that transition from one to the other.
Hey, Greg, we have a couple questions.
Yes, please.
Interrupt you here. Okay. So we don't always know the risk in our own companies. So what's the best practice for assessing risk, and should there be an external hire for this?
It depends. It depends how far into the process you are and how deeply you want to dig. One of the first things I would say is to take the time, take a day, and truly put yourself in the shoes of a potential buyer and walk around the office, walk around the shop floor, do whatever, and think about how each of the steps in the day would look from a buyer's perspective. Is there anything where the processes are documented? Could you, as the business owner, turn your phone off for a day? If you can, and the business continues to run smoothly, great. Now, what if you want to go to Costa Rica with no cell service for a week? Is that, can you do that without it being, a huge deal for the continued viability of the business? Next, what if you have a stroke and you're in the hospital for a month or 2 months or 3 months? Is that business going to be there when you get back? If not, what are the things that are going to be the issues along the way? Where are there people that don't have the information that they need to make the decisions? Where are people not empowered to make the decisions or make a new hire to replace somebody? And yeah, sometimes in an apocalyptic situation like that, people will step up because they have no choice but to do that. But you'd much rather have it be clearly defined roles that are, documented somewhere and that people are comfortable doing it, as opposed to it being a catastrophic situation that forces them into it. That's one way to look at some of this stuff on your own. There are certainly people that will come in and do, risk consulting, for lack of a better word, or temporary CFO type services where, they can come in and start looking at, where are the pinch points for stuff like this. We do a little of it when we're doing valuation work, but like I said earlier, so much of it comes down to key person risk that is where I think the vast majority of the time should be spent, at least up front, is understanding how can you as the business owner extract yourself from the business and empower your people to do things in your absence. That is the vast majority of it, for at least the low hanging fruit. Some of the stuff like, customer concentration or, lack of geographic diversity, things like that. I mean, some of them are just the nature of the business that can't really just be, you can't flip a switch and change that stuff. So I really spoke around that answer, but it's hard work and looking deeply in the mirror, I guess I would say, is the best way to think about it, as a first step.
Okay, so kind of leading off of that, what can a business owner do to create shareholders value?
Increase cash flow, reduce risk. That's the short answer. Each one of those on their own have an impact, but it's when the two of them it's like one's the lever and one's the fulcrum, and they're working together to really drive value. The reduction of that risk is the easier one most of the time. And again, just that key person risk that we were just talking about.
Mhm.
Making a business saleable is the biggest one that I would say. Whenever I'm talking to a client and they say, what's our deal, or could we actually sell this business? Because a lot of business owners, for everyone that we have that's overly optimistic, we have plenty that are overly pessimistic. Oh, I could sell this business? No way, nobody's going to buy this from me. We had a guy that ran like a 12 crew plumbing and mechanical contractor that was doing like $2 million a year in Ebitda. And when he was ready to retire, he was just going to shut the business down. And I was, whoa, no, I'll move to the city you're in and take it over if you're shutting that thing down and essentially giving it away and selling the trucks. Like, that's crazy. Understanding if I always tell people when I'm meeting with them, could Greg sitting here come in and buy your business and you could move to Florida tomorrow? If I had the money, which I obviously don't, but could I come in and do that if I had the money? And if they said, well, yeah, you could, but you'd have to, I'd have to get, Jenny would have to understand, and get the logins for the QuickBooks, and, I'd have to, and you can see it start turning over in their mind and say, well, I'd have to do this, and this, and then, you'd probably want me around for 6 months. And those are the things that really reduce the value of a business when there's all this, yeah, you could, but those are all the things that make that business harder to sell and therefore worth less. So that reduction in risk is usually the thing that really raises shareholder value and takes it from being a business that might be a multiple of 3 times Ebitda to 4 or 5 or 6 times Ebitda. Because when it is a saleable business, the universe of potential buyers really expands. And that's when you get that competition to buy it, which raises the price. So again, not an exactly prescriptive approach that I just gave as an answer to that question, but there's no real easy one thing, unfortunately, to say what you can do to raise value.
Right. Okay. And then I've got one more right now. Do you assist buyers in purchasing a business? The business is already known and the process is started. This individual would like help in developing an accurate valuation.
Yes, that is a large portion of what we do. That's actually really, I almost prefer doing that on the buy side versus the sell side, because it's that hunger that's driving the person. They're enthusiastic. They want to grow their business. Whereas on the sell side, it's so often somebody who's retiring and they're hesitant about wanting to sell, or it's been health that's forced them into selling. So yes, we love coming in and helping somebody understand what the true value of a business is, on either side, but it's more fun on the buy side a lot of the time. And I always tell people, if you're hiring me, I am coming in to give you a fair number. I don't care if I'm working for the buyer or the seller. You cannot make a good and informed decision if I'm just purely working as an advocate for you or for your side. I'm not going to sugarcoat it as the seller and say, oh yeah, this is worth way more than it's actually worth. That doesn't do you any good. Same thing on the buy side. I'm not going to say, oh yeah, you can get this thing for cheap, because what's the point? You can offer whatever you want, but I'm going to tell you what I think it's worth, because that's how you make a good decision.
Okay, wonderful. I will make sure everyone has your contact information to all of you.
Great.
For
Great.
afterwards.
Appreciate that. And I always tell people, I like this stuff. Everything doesn't have to be a project with a bill at the end. If you want to chat through something for 15 minutes, whatever, call me. No charge for stuff like that. I don't even put my office line in my signature of my emails anymore, because I'm never there with all the COVID stuff and being a firm-wide resource. So my cell phone number is my contact info. Call me whenever. There's no, this is not a 9 to 5 for me.
That's great. Okay, we have one more just popped up. How
Sure.
does sales concentrations impact value and risk in the evaluation process?
So we will typically look at, how concentrated are the top 10 customers or top 20 customers, and look at how concentrated should they be in an industry. If you're a tier 1 auto supplier, for example, you've really only got 8 customers or 10 customers, because that's how many automakers there are out there. So if your top 5 customers were 50% of your business or 80% of your business, that wouldn't worry me, because that's the nature of that industry. If you were a produce distributor and 50% of your business were your top 10 restaurants that you supply to, that would really concern me, because any one of those restaurants could go by the wayside tomorrow. So that's how we're trying to look at it, both from a quantitative and a qualitative perspective, to understand, are you more concentrated than you should be? What is the financial strength of your customers? Is it contracted business? Have they been long-term customers? If you're a supplier of medical goods and you're supplying to a large hospital, and you've been supplying them for 30 years and you're contracted as their sole supplier, and it's a big chunk of your business, that might not be as big of a risk if it's you got a one-time purchase order from them, and you don't know if it's going to continue, and you've never done work with them before. So there's no short answer to some of this stuff. It's just, how does it impact the risk profile and the cash flow of the business? You can see in my industry, there's not a lot of simple answers. There's a lot of shades of gray. It's not like accounting where there's one right answer. It's as much art as it is science, because no 2 companies or situations are the same. So very important considerations here are pre versus post-tax proceeds. Is it a stock sale or an asset sale? That right there can make a difference of 30 or 40% of your post-tax proceeds. Can change the post-tax proceeds by 30 or 40%. Is there personal goodwill in the business? That also, if you're a C Corp, can impact how much you're paying in taxes on a sale, and if you're being taxed at the personal level or both the corporate and personal level. Same thing, C Corp versus S Corp or LLC. Very large differences in the tax treatment for C Corps versus S Corps in a sales situation. An offshoot to that is, if you are an S Corp, how long have you been an S Corp for? There's certain rules that change all the time, where there's what's called built-in gain, that even if you're an S Corp for a certain amount of time, you would still pay 2 layers of tax on that built-in gain if you haven't been an S Corp for long enough. So significant difference on this stuff. Talk to your tax person. If you're getting tax advice from me, we are probably both in trouble. That's not going to be good for anybody. And this is another spot where there is significant value in planning ahead. Anything you can do to get in front of this stuff, talk to your CPA, to understand, hey, I'm thinking about maybe selling. What are going to be some issues? What's my basis? Is there anything we can do ahead of time to pull some non-operating assets out of the business, to do it ahead of time so it's not involved in this transaction? I don't even know some of the questions to ask on that side of things because I'm not a tax professional. I think I missed this slide when I was flipping through. Qualifying buyers, we talked about. How much of a down payment are you getting? Are you in effect financing some of the purchase price through taking a seller note? There is a lot of risk associated with that. And I'm going through one of these right now where it's about a $3 million sale and the buyer wants to, it's two 50-50 partners, and the buyer wants to pay $500,000 down and $2.5 million over the next 5 years. And we talked about it, and me and the seller, my client, were like, why would we ever do that? In effect, I'm locking in the value right now, even though this business is growing like crazy, and all I'm getting is downside risk. I have no upside potential whatsoever, because if this business is worth $20 million 5 years from now, I'm still only getting my 2.5. So that's the risk of a seller note a lot of the time. I don't recommend them unless they're a small amount, and it's at a reasonable interest rate. Especially right now, it is so easy to borrow money for buyers, and it's such low interest rates. Why, if they need you to finance part of it, I would say that's a bigger problem that they have in their credit profile or something like that. Could be necessary if you're trying to get them to pay for a considerable amount of upside in the transaction, and that's fine. But I would prefer it to be an earnout. You know, if revenue grows by more than 5% in any year of the next 3 years, we get 5% of that increase in revenue. That's much easier to say, you know, to look at for me, to say, okay, this is our base deal. This is what we think or know is going to happen. You're taking on most of the risk. We think it's going to be worth more than that. So we want a little bit of upside since you're not willing to pay for it up front. I'd much rather that be an earnout than a seller note. So looking at some of the current valuation trends, these are multiples of price to Ebitda. You can see back, you know, the tail end of the financial crisis, pre-Tax Cuts and Jobs Act, multiples for small businesses, privately held businesses were kind of trending in this 3.5 to 4 times Ebitda range. Then Tax Cuts and Jobs Act passes, which means more after-tax dollars are remaining in shareholders' pockets. So that raises things quite a bit. You know, you go from a 39% effective tax rate to 26%, 25%. That should raise multiples because there's more money left for the buyer. So you can see that kind of raised the trend overall. Q2 was the first time average multiples dropped below 4 in, you know, what's that, 3 years basically. So that was just some panic selling at the beginning of the pandemic. But it did rebound nicely in Q3 and Q4 once people saw how resilient the market was, and how businesses that were in good position and good industries were still making money. We had a good chunk of companies that we valued last year, or, you know, in the last couple months, that 2020 was going to be their best year ever. Never would have expected that. Didn't think I'd see a whole lot of that, but it's been more common than I ever would have expected. So here's market volatility. People always want to talk about volatility as equaling risk, which it kind of does in the public market, but it's really just price risk. You know, sure, our underlying factors driving volatility in prices, and therefore it's indicative of risk. Yes, to some extent, but just because there's volatility in publicly traded share prices doesn't mean that that volatility is as pervasive in private businesses. public companies trade at such high multiples that they're going to move up and down. How can they not fluctuate when you've got some of these private companies trading for 50 times earnings? You know, the smallest little whims of the market, analyst upgrade or downgrade can change things so quickly. An earnings report, things like that don't really matter all that much a lot of the time in small businesses, but do very much so in public markets. That's what drives their market volatility. And I don't want to confuse that with risk, because let's think about it. What is this? In the first quarter of 2018 and the fourth quarter of 2018, was there anything that made the risk and therefore volatility of companies jump from, I mean, it's an arbitrary scale, but from 10 to 30? No, I sure can't think of anything. I mean, there wasn't 3 times more risk in that company from the middle of the year to the end of the year. If you looked at market volatility, it would say that, but that's where there's the big disconnect between publicly traded companies and privately held companies. So the 800-pound gorilla in the room is private equity. Private equity drives a ton of volume of transactions and really drives multiples up. What this shows me here, so this is what they call dry powder, which is cash that private equity firms hold that they have not yet spent. You can see it increasing year over year over year since, looks like 2011 or 12, to $1.5 trillion. What that tells me, seller's market, seller's market, seller's market. We have this aging baby boomer generation that is the largest cohort of business owners. And eventually they're all going to have to get out or transition to the next generation, whatever. And at some point, this relationship between number of buyers and number of sellers out there is going to change to where it is absolutely a buyer's market, because most of this 1.5 trillion will have been spent, and there's going to be a ton of business owners left holding the bag. I think it's a great time to get out. Maybe, wait a little while to have results recover if 2020 was a bad year. The one good thing about, as pervasive as this pandemic was, is it's going to just kind of lead to everybody throwing out the bad year from historical results that 2020 was, as long as 2021 rebounds. It's going to be very easy to say, no, that was an anomaly, because if it were some, unique industry specific thing that nobody else really knew about, you say, oh no, it was a bad year because of X, Y, and Z. Buyer will be like, oh yeah, great. Yeah, I'm sure that's really what it was. It wasn't just that your business did bad. There's no denying the pandemic. So as long as 2021's good, I think it's easy enough for a valuation person or a buyer, whoever, to say, yeah, let's ignore that from historical results. It was a true one-time item. So why is it that this dry powder, as they call it, is ripe to make this a seller's market? Private equity has to either spend this money or give it back to investors. And that's the worst possible thing you can ever do if you're trying to raise money again in the future, is say, yeah, we held on to somebody's money for 7 years and never deployed it. Fastest way to ruin your fundraising efforts. Private equity usually focuses on larger businesses, unless it's like a smaller, like bolt-on acquisition or something like that. And that's what leads to a large disconnect between multiples like these and the huge multiples you see in publicly traded companies. Nothing can ever justify 128 times earnings or even the current 36 times earnings, as far as I'm concerned. But you have to look at not only the numerator, also the denominator. Is it that prices have gone up too fast, or is it that earnings just haven't caught up to it yet? All valuation should be forward looking. So it's really a matter of, if people are placing these high multiples on stuff, it's not necessarily that they're overvaluing it. A lot of the time it's they think that future results are going to be great and just haven't happened yet. Here's that private equity deal flow. You can see how little they got done in 2020 because of the madness that 2020 was. So that's another thing that tells me seller's market, seller's market, seller's market. There's going to be a ton of deals coming in the next 12 to 18 months if my low budget crystal ball is any indication. So just some key takeaways. You've heard me say cash flow and risk about 20 times throughout the past 50 minutes. It really is, those really are the two drivers of value in some way, shape, or form, no matter how we're looking at it. Prepare, and prepare some more. You can't do much to change things if you start planning 3 months before you want to get out. If you ask me, it's 2 years, 3 years is the best time to start doing it, because that's when you can truly effectuate some real change that's going to drive the value of a business, the saleability of a business, the marketability of a business, have time to find not just a buyer, but the right buyer. So plan ahead. Remember, it's not personal, it's just business. People aren't asking questions to offend you. They're digging into stuff to protect their investment. And if it's a question that offends you, sometimes that can mean maybe it's something that you should have thought about ahead of time. Because if it strikes a chord, that means you know it's important, and people usually get defensive because it's not why are they asking that question. A lot of the time it's why didn't I think of that before. Taxes, death and taxes, only certainties in life, so they can play a huge role. And then, as we talked about preparing, timing really matters a lot. I think it's a great time to think about selling now if you know that is something that's happening eventually. But it's always that trade-off between, have I prepared enough to get it done in the time where it could be a good time to sell? So those are kind of the various takeaways that I think are important from this. Sorry, I know I have a tendency to just kind of keep talking on this stuff. I wanted to leave a lot of time for questions at the end. We talked about a few throughout. I know we only had an hour on the books, so if I see a mass exodus of people from the Zoom, I completely understand, but I am here as long as anyone would like to ask any questions or talk about anything else. Emily, anything else that came in, or we looking pretty good?
Hi, Greg. Emily's screen is frozen on her end, so I'm gonna take over.
Sure.
And I think she's sending me over some texts here, so hold on just 1 second. One that she said, or that she got a question on, is do you foresee anything, tax or law changes with the new administration that would create some urgency in going through the valuation process now versus later, or vice versa?
So not being a tax person myself, I don't want to try to hypothesize too much on what those changes are going to be, but I know that kind of the mass opinion is that there's going to be some changes to estate tax law. So we're seeing a lot of people doing gifting or other estate tax planning or estate planning. Whether it's, I don't even know what some of these acronyms mean, but IDITs and IJITs and all these things that are ways to start transferring assets to the next generation. We're seeing a ton of people do that now in fear of what might happen. From a valuation perspective, it's hard to say. If taxes go up, that certainly could have an impact on valuation multiples. But as much as that might push them down, I think the private equity stuff that I talked about here and the built up dry powder, I think that's going to keep multiples strong for a while. And like they say, a rising tide lifts all boats. Even if there's not a ton of non-private equity transactions going on, the multiples that people are going to see from that are going to force private buyers to to really come to the table to offer fair purchase prices. So I don't think it's going to have a huge impact from a transaction value perspective. I think it's more so from people having to get stuff done for estate planning.
Okay, thanks, Craig. And then another one is, can you please share a few pros and cons of an asset sale versus a stock sale?
So a little bit of a tax question, but I will do my best. Buyers typically want an asset sale because they know they are buying purely the assets and possibly taking on some of the liabilities unencumbered with any of the bad stuff that could have accompanied it in the past. Like a potential lawsuit or warranty reserve, things like that. A seller would typically really prefer a stock sale because they're not selling the assets first and having a gain at the corporate level, and then again distributing proceeds to themselves from the company and recognizing another gain. So typically people would prefer a stock sale for for their personal from their personal tax perspective. We had a situation where a buyer, a big private equity firm, actually had a typo in their letter of intent, and they said it was going to be an asset sale. And we were doing all this work to have ammunition as to why the value should be higher, because we had to get it higher for them to get post-tax proceeds of what they needed under an asset sale. And I mean, I had reams of documents with all this support and everything. And then they fly in on their private jet. And the first thing my partner says, he says, I think we're gonna have a problem with this being an asset sale. The guy says, oh, no, don't. The total typo, it was supposed to say stock sale. And we're all like, huh, okay, just did all that work preparing for nothing. But it was, a great result for the client. And I couldn't believe that they made a typo on something that important. But usually asset sale is what the buyer wants, stock sale is what the seller wants.
Okay, I think that's it on our end. Those are all the questions that came through the chat into email. So if anybody else has any, they're more than welcome to chime in now. Otherwise, oh, hold on, I've got one from Philip Lee. If a company is in a unique business segment and you're not sure how other companies in the same segment would be valued, what other measures can use to help with the valuation?
So in that situation, we probably can't use a market approach. A market approach is where we would look at transactions of similar businesses and use the multiples that those similar businesses sold for and apply them to the company we're valuing. If there's no good market data, we can't really apply that approach. In that situation, we're doing some form of an income-based approach. And that's where we're looking at what sort of cash flow has the company generated historically, what are the expectations going forward, and then applying some sort of a risk factor or required rate of return, which then translates into a multiple. That multiple gets built up instead of from those market transactions. We look at these required rates of return from the public markets, and it's kind of a buildup where we start with a risk-free rate of return, an equity risk premium for the risk associated with the uncertainty of the market, and then we add on a company-specific risk premium onto that, which could be related to the size of the company from some calculators that we subscribe to and some studies we subscribe to, and then it could be some specific required return factors for the company, like that customer concentration or lack of management depth or any other strange type of thing that we think is specific to that company versus a typical company in that industry or of that size. And if that's something anyone would ever like to discuss further, I have some sample reports I can share to show what the actual methods look like, those kind of things. And probably to better to do it offline to not put anybody to sleep. But that's something I'm happy to do at any time if anyone ever wants to reach out.
Okay. Well, that looks like everything. So thanks everybody for joining us today. Greg, thank you for representing Rehmann and giving us some information on valuation. And of course, we always want to thank our sponsors, Fifth Third Bank, Highland, Eastman and Smith, William Vaughan Company, Rehmann, Shoemaker, Lupin Kendrick, Skylight, and Huntington. I'm going to post some of our social media handles and our website so people can follow us. You'll see that coming through soon. And other than that, everyone have a great day. Thanks again, Greg. Appreciate it.
Thank you very much. And thank you everyone for attending. Have a nice day.